You may have a disabled child who's turning 18, and you've heard from others, maybe other parents that you know, that your child might qualify for a benefit called Supplemental Security Income. What is that? I'm going to talk in this video about what SSI is, Supplemental Security Income, how your child can qualify, what are its benefits, what are the limitations, and how do we overcome those limitations? So I hope you enjoy. Hi, this is Ellen Cookman. Welcome to my channel. In this channel, we talk all about how to help special needs families set up their estate plans. Estate planning for special needs families is complex, and we try to make it as easy as possible for you. If that information is helpful for you, please consider subscribing and hitting the notification bell so you will be notified when new videos come out each week. My law firm has helped hundreds of families navigate the complex process of setting up estate plans. So I'm excited to share all of my knowledge and experience with you. So first of all, what is SSI? Well, if your child is disabled and they can't work because of their disability, then they're not able to get an income stream that you would get if you're working. So the government instead will provide an income stream for your child. It's called SSI. And the idea is that it supplements whatever income your child is already receiving. That's why it's called Supplemental Security Income, SSI. In California, SSI pays up to about $1,040 a month of income, and that's in 2022. California actually supplements the amount that the federal benefit rate is, which is about $841 a month. So you get more in California, but here's the kicker. This is supposed to pay for your disabled loved one's food and shelter, which is really funny. I mean, can any of us survive in California on $1,040 a month? I don't think so. But this amount was set in the 80s, and it really wasn't indexed much for inflation, so that's what we're stuck with. However, there's a few nice things about SSI. First of all, it is an income stream, and if your child doesn't receive anything, it can be very beneficial. And the other really nice thing is that if your child gets even just $1 of SSI, they automatically qualify for Medi-Cal, which is California's version of the federal Medicaid system. So a lot of people want their child to be on SSI so they can also get Medi-Cal. Also, if your child's receiving SSI, there may be other government programs that your child can qualify for, such as housing programs or day programs. So it's really worth looking into. You may think, my child doesn't need $1,000 a month, I'm going to provide for them. But it can really open the door to other benefits programs that you might want to know. Now, I'd like to put SSI in context of the four main types of benefits programs, and I have a handy dandy chart here. All right, so you'll see up in the left-hand corner, we talk about SSI, right? That's a needs-based program, which means that you can only have up to $2,000 of countable assets. And I'm gonna talk about what that means in a little bit. And then if you, as I mentioned, if you have even $1 of SSI, you qualify for Medi-Cal. Now I wanna compare SSI to SSDI, all right? There's only one letter of difference, but it's a huge difference, all right? SSDI stands for Social Security Disability Insurance. Here's the problem. SSDI and SSI are run by the same program, by the Social Security Administration. So if you're receiving either or both of those, you're getting a letter from the same place. So it's really hard to distinguish for a lot of people. Are they getting SSI? Or are they getting SSDI? So here's the trick, okay? SSI, you only get up to about $1,040 a month. So if you, or you're looking at your loved one who's disabled, if they're receiving more than $1,040 a month in income stream, then it's SSDI. SSDI is when somebody has been working for a while and then they become disabled. Then they receive the income stream of SSDI. Another way to qualify is if your parent was working for a while and then they retire and you became disabled before age 22, then you can qualify to receive half of what your parent is receiving in Social Security. So let's say your parent is receiving $2,500 a month of Social Security benefits. You, in addition, receive $1,250 a month of what we call CDB benefits, child disability benefits. all right? So it's run by the same umbrella program, but it's a different income stream. Now, SSI is intended to supplement what you already get. So let's say you worked for a while and then you became disabled and you're getting $500 a month in income. So SSI would supplement whatever that is by the extra amount. So it would be about another $500 a month that you'd get in SSI benefits. So a lot of people get both. They get SSI and SSDI, or CDB benefits. All right, now the really nice thing about getting SSDI or CDB benefits is after 2 years, you qualify for Medicare, which is another health insurance program, which is super beneficial. So I have clients who are receiving both SSI and SSDI. I have clients who are receiving both Medi-Cal and Medicare. I feel the more the better. Bring it on. Now, this is one of my favorite charts I've ever developed, and I'm sharing it with you today, all right? This is my public benefits timeline. So this gives you an idea of when might people qualify for different public benefits, because it's not a static thing, all right? So you'll see when somebody's born, they might receive Medi-Cal, and this video isn't about Medi-Cal, but just so you know, there's a waiver program that the state of California can pay for. So disabled young people can receive Medi-Cal even if their parents have too much money otherwise for them to qualify. All right, and then you see at age 18, all of a sudden, the child's money is not the same as the parent's money. The parent's money is not deemed to the child. So now the child becomes poor and they can qualify for SSI because they'll have under $2,000 of countable assets. And we'll talk about also what happens if they still have money in their account for different reasons. All right, so at age 18, they can start receiving SSI benefits, all right, that income stream that we're talking about. Now let's say the parent then retires and the child's around 40, 42, all right? Then the child starts receiving CDB benefits. And they can also receive SSI benefits as long as the CDB benefits are not greater than $1,040. Remember, SSI is to supplement anything that you already get in income. Okay, so if your CDB benefit goes above $1,040, you're not going to get SSI anymore, but you can still qualify for Medi-Cal happily. All right, so then we're going and going, and then let's say the parent dies. Once the parent dies, the child receives 3/4 of the CDB benefit. So that might bump the child off of SSI. I don't know. It depends on the child's actual numbers. So hopefully you found this chart to be beneficial. So how do you qualify for SSI benefits? Well, as I mentioned, you have to have under $2,000 of countable assets, and you must be qualified as disabled. So what does that mean to be disabled? Well, they're really looking to see if you're able to work and support yourself. If you can't work and support yourself for at least 12 months, and you can't earn enough income for the federal poverty level, which is about $1,300 a month, then they might qualify you as disabled. Now, if you've applied for SSI and you've been denied, then I suggest you work with a consultant. We don't do this, but there's consultants out there and other attorneys who will work on an appeal, because a lot of times people get denied the first time around. So don't let that discourage you, okay? But it is something you might need to work on. So you need to be disabled and you need to have under $2,000 of countable assets, all right? Well, what does that mean, countable assets? So I have a handy dandy chart where we talk about that. So these are the things that you can hold on to and things that you have to get rid of in order to qualify for SSI. The things you're allowed to have. So interestingly enough, you're allowed to have a house of any value here in California, and that is what we call an exempt resource. That means it doesn't count towards the countable resources. You can also have one car. It can be fitted for you, it can be a more expensive car, but you're allowed one vehicle. Also, they look at what household goods you might have. Those are typically exempt as well. Now, you shouldn't have like a Stradivarius violin or, a Ferrari, but as long as it's reasonable, that really doesn't count towards the $2,000 limit. There's a few other things that you can have. You can have a life insurance policy and burial spaces with a $1,500 limit. If you have property that you've used in a trade or business, or you're self-employed and that's property that you're using, that's exempt. And also, you can have money in an ABLE account. And I do have a very good video that talks all about ABLE accounts. All right, so check out that video as well when you're done with this one. So you can have up to $100,000 in an ABLE account, and it still does not qualify as a countable asset. So that's actually a lot of stuff that you can have while still having under $2,000. But here are the things that would disqualify you, all right? If you have cash or bank accounts, it could be a mutual fund, it could be a CD, but anything that's in your name or held jointly with a parent or somebody else, that does count as your stuff. Also, a non-residence, a house that you're not living in, that would also disqualify you. So that you'll have to get out of your name. Most life insurance policies, we already talked about the valuable personal properties, other vehicles besides your vehicle, and then other things that could be changed into cash for food and shelter. So if you have a gift card that can be transferred into cash, that would count against your eligibility. And then I say deemed resources. So that's if you're under 18 and you have your parents who have assets, then those assets are deemed to you while you're under 18. Once you're 18, you're an adult and their money doesn't count towards yours. If this information is helpful to you and your community, I ask that you please hit the like button below. This will help YouTube to spread the reach of this video to more and more families that could use it. So now let's say that you have a child who you really were thinking about their future when they were born, and you set up an UTMA account, a custodial account for them, or a 529 plan. And now, that money distributes outright to them at a certain age, and that will bump them off SSI. That becomes their money. What can you do? Well, one option is to create what we call a first-party special needs trust. And that's a trust that your child can receive their own money into that trust, and it still protects from public benefits. So if your child is getting SSI and they have money in a first-party special needs trust, that is not a countable asset, and it doesn't count towards their eligibility. So it's a really great planning tool. So if that's your situation, we would be happy to help. Feel free to reach out to our office if you're in California. Now there's this rule for SSI that I want to talk about that you may have encountered already. So remember that I said that SSI is meant to pay for your food and housing. So what if somebody else is paying for your food and housing? For example, if you're living with your parents rent-free and they're paying for your food, or maybe you're living in an apartment that your special needs trust is paying for. If that happens, then you get what's called an ISM deduction, which counts for in-kind support and maintenance. ISM. And basically at Social Security Administration, they deduct about $250 from your SSI money because they figure, you don't need that money. Somebody else is paying for your food and housing. I mean, really? But they do. I want to talk about how to get around that ISM deduction, and that relates to the ABLE account, which I talked about in my last video. So take a look at this diagram. Okay, so on the left, as I was describing, if someone else is paying for your food or housing other than you, so that could be a third-party special needs trust, that could be a parent, that could be a family member or someone else, then that ISM deduction is probably happening. So you're probably getting about $750 a month or $700 a month in SSI benefits, as opposed to the full $1,040 a month. Not great. You might say, oh, that's worth it, that's okay. However, here's how you get around this. And I promise you it's perfectly legal, all right? So if you set up an ABLE account and then your parent or the special needs trust transfers money, say $1,000 a month, into the ABLE account, and then the ABLE account pays for your food or housing, there's no ISM deduction. I know, it's amazing, right? The reason why it works is because the ABLE account counts as your money. So it's as if you are paying for your own food and housing. They don't care where the money originally came from. As long as that money is in the ABLE account and then it's used to pay for food and for housing, that works great. Now, sometimes people don't like setting that up. Let's say that you live with your parents. They're giving you money to pay for food and housing. Then they get the food and housing. They get the money for that. They have to report that as their income to the IRS, and then they have to pay income taxes on that income. So they may choose not to set it up that way. But if you're in a a different living situation. You know, this could really make sense in a lot of different scenarios. So we're so happy with our ABLE accounts because that really does legally allow us to eliminate this ISM deduction so you can get the full $1,040 a month of income. So I've talked a lot in this video about ABLE accounts. I really encourage you to go to this video where I really go in depth about ABLE accounts and how they can benefit you and your family. So I'll see you over there.